You want to know, shoot, I want to know, is the bottom in? Are we going lower? If lower, how much more? Is it time to buy? Well, when it comes to the stock market, there's only one guy I turn to, and that's the guy that's been with us for almost 5 years. That is Dan Bird, aka Breakpoint Trading. Go check him out on YouTube. Alrighty, Dan. First off, happy Easter. Thank you for recording this Easter morning. I
You
gotta
bet.
know, is the
Happy
bottom
Easter.
in?
We're going to find out. We're going to explore that topic.
Awesome. Well,
Um,
educate us, share with us, let us know what's going on.
Happy Easter to you as well.
Thank you.
We're getting with our family later today, so we've got time to do this. This
Nice.
is, by the way, this is like 1 o'clock Eastern time right now for those out there. I know this drops later on Sunday, but well, yeah, let's do. There's a couple of things I want to cover with you. One of them is specific to real estate, as a matter of
Okay.
fact, and I want to start with that, and then I want to go to. I went through a whole series of charts on my YouTube yesterday or Friday because
Okay.
the market was closed. So I went through the whole thing, but so people can go back and watch that if they want to watch them all. But there was one in particular that really sparked my interest, and that's the
Okay.
one I'm going to focus on after I talk about John Carter a little bit. So
Okay.
John Carter is an amazing options trader.
Mhm.
He looks at everything. Guy's brilliant, and he does a lot of macro analysis, and especially with cycles. So I want to touch on a couple of slides that he shared in his webinar.
Okay.
Before I do that, though, just so people don't think that I'm trying to steal his thunder or anything,
Hmm.
first show my YouTube channel, Breakpoint Trading. It's right here.
Right.
You
You're
can
not
get to it.
sharing. You're not sharing.
Oh, well, then you can't see it, can you?
No, I can't. Nor
Let me
can
try.
they.
Let me try this. How about
There
that?
we go.
All
There
right.
we go.
So this is my website, breakpointtrading.net. My YouTube channel is right in the upper right-hand corner. That little link right there. And it'll take you to this. So I try to post one every day. By the way, starting Wednesday, I'm going on a 2.5 week road trip.
Okay.
So I may not be able, I probably won't be able to do these on Sunday for about 3 weeks.
Okay.
I'm going to still try to do the YouTube channel after the market closes, but I can't guarantee I can do that either
Sure.
for the next
Yep.
for the next few weeks. But just want to throw that out there. But it right down here in I have one playlist that I've created called Technical Tuesdays. This is where I talk about a particular indicator or technical analysis, and it's really a teaching session. And I
Hmm.
put all of those sessions right here in this playlist. But I also, in the playlist, included this one from John Carter.
Oh, nice.
Not that one.
Yeah, that's just an ad.
This one.
Very cool.
So John Carter is a brilliant guy. I'm going to show you some of the slides that he showed, but I highly encourage anyone that's interested, especially from a macro view of what's going on in the market and what might be coming down the road in the next few years. He does an incredible job of explaining all of that.
I like
So
it. I'll
you
check
can
them out.
you can find it on YouTube. You could search for it if you want to, or you could go to my YouTube channel and it's right in Technical Tuesdays. I've got the link right there,
That's a
and
great idea.
you can just watch his video from there. But I'm gonna just quickly. I have the slides, and I'm going to quickly go through a couple of them, and there's one in particular that I want to ask you about.
Okay.
So he talks about cycles, tariffs, global liquidity in particular. He said that really is the key to whether
Hmm.
the market is going to go up or down,
Okay.
whether there is liquidity globally. So this is kind of a summary, does another summary later, 17-year cycle in stocks. According to him, Q4 2007 was the peak.
Okay.
So that implies 17 years is Q4 2024.
Okay.
We just had a couple of months ago, right?
Yep. Hmm.
So that's implying that that's the peak. I have a little bit of an issue with how he's calculating this
Hmm.
because you did not know that this was the peak
Until
because it went down
validation.
from here.
Okay.
So you don't know it's the peak until it breaks out above the peak.
Right.
So I would have chosen 2013, which is the point where it broke out,
Hmm.
rather than 2007, which would put us at 2030, not 2024.
Got it.
But regardless, there's a lot of his premises based on this. So, usually when it hits a peak, pulls back 20%, we pull back 21%.
Hmm.
He says between 20 and 50, but we pulled back 21.
Okay.
Interesting, March 20th to April 20th is typically an important transition period, sets the tone for the rest of the year. So we're in this as of today, exactly, April 20th,
Hmm.
right?
Yep.
So so keep that in mind. We will see what happens. So the tone right now is negative. The tone
Oh,
for
no
this
question.
period is down, right?
Hmm.
So we'll see what happens next week when we start over again. So historically, it's led to a major recession. He's calling for it in 26. He actually said it might get delayed a little bit later, 27 possibly.
Okay.
Um, uh, so these are the key things. Interest rates should see lows by mid 25.
Really? Okay.
Gold and silver positive. Onset of a new 40-year cycle.
Mm.
US dollar has peaked, looking for a drop into late 2025.
Okay.
This is all part of global liquidity, by the way.
Right.
Oil is neutral, range bound, probably will head back to the upper range. Commodities, rising prices can impact inflation numbers,
Okay.
right? And then he's got some charts, and I have charts of my own. But this is the one that piqued my interest. And this is, um, I had never seen this before, but this is not his slide, but he pulled it out from somewhere else. This is
Okay.
part of the 18 and a half year real estate cycle.
Hmm.
Are you familiar with that?
Of course. Yep.
And would you agree that this is the cycle? I mean, he's pointing to 2026, 2027 as the peak. Next 3 years, 25 to 27.
Yeah. So let's talk about cycles first. My
Yeah.
general feeling, again, you're the stock guy. I'm not. I'm the real estate guy.
Mm-hmm.
Generally speaking, there's been lots of people that have tried to paint cycles and make them very much time bound. So you could,
Yes.
artificially pick some date in the future and
Right.
say something about it. I generally believe real estate moves a lot slower, certainly slower than stocks. I don't think, the behaviors that you see in the stock market are easily represented in real estate. Real estate sells a lot slower. It's a lot stickier. It's a lot less efficient, if you will. So I'm not a huge believer in cycles, period,
Okay.
in real estate. That said, if you want to talk about land, right, a component of real estate, I do think land has attributes of a real estate cycle because,
Mm-hmm.
again, um, for the longest time, builders would stack land. People don't realize that that changed in the last cycle. And again, this is why I think the cycle breaks because the cycle had assumed for, 100 years that builders operated the same way. And they just became land banks, right, where they were owning land and moving them out. That's no longer what they do. They now realize that holding land on the balance sheet is really a liability and hurts their ability to perform. So they're fundamentally treating land different. Lots of lease options, a lot of options to buy. So they're not adding land to their portfolio. So I think for a long time, land was a great indicator. But once the main entity, in this case, builders, fundamentally changed how they buy, secure, and build land, the model breaks, in my
Okay.
opinion.
So that's interesting because he did not specifically call that out, but I think that probably is what this slide means. But I think a lot of people probably assume this is just real estate in general, not specifically land, unless you look at the top of it. But he did not specifically call out just land. He just said real estate. All right.
Sure.
So he's projecting a peak somewhere in 26, 27, and then it will fall dramatically from there.
Yeah, so this is where I really have a problem with this because I've done work all the way back to 1970 in detail, which is now 55 years. And other than the Great Recession, real estate hasn't had down years. They've had plenty of flat years. They've had plenty of years adjusted for inflation or real, where there's been downturns. But it's really hard to look at the last 55 years, ex GFC, and say real estate goes down like this. It just doesn't
Mm-hmm.
happen. It's
Right.
not historically accurate. If you look at the 17 years, what would that be? That means we had three down cycles in the last 54 years. We haven't.
Mm-hmm.
We've had one.
Right. Yeah, that's a good point, and that's kind of the issue I have with him taking the 17-year stock cycle too
Mhm.
and starting it from 2007
It's
because
convenience. Yeah.
anyone that is a critical thinker would say, okay, well, let's go back the other way. Let's
Right,
take
exactly. What
2007 and
happened then?
subtract 17.
Exactly.
And
What
that should
happened
have
then?
been that's
Yep.
1990. 1990
Hmm.
was right in the middle of a secular bull market. That wasn't the peak yet.
Hmm.
The peak was 2000. So
Yeah.
just that by itself breaks it, right?
Yeah.
And
I
the other
think a
thing that,
lot, yeah, I think a lot of people love cycles because it's easy, right?
yeah,
A lot of people will click on this, a lot of people will watch this, a lot of people will say, okay, great, I get it. It has to be true. They
right,
don't reverse engineer, to your point, and go back 17 years and see what happened, or go back 34 years, or go back
right,
51 years. I
right,
have the data and have shared it with the world. It's free on my website. It's just not
yeah,
accurate. It's cute.
yeah.
Um,
The other issue I have with the way he presented that 17-year cycle is he's presenting it from peak to peak. So
hmm,
he's presuming that it's the peak was in 2007 and then 17 years later is 2024.
mhm.
So he says that's the peak. Well, he's ignoring the 12-year bear market cycles
Yeah,
that come in between. Why
yeah,
wouldn't 2000 be the peak instead of
yeah,
2007, right?
yep, yep,
Which means the next peak was 2017 and it wasn't.
yep, yep. Well, of course, it invalidates his pretty chart. That's why.
Right. So, I mean, yeah, he has some good points, but I don't totally go along with everything. But here's some other.
So let me close on one more thing. I
Yeah.
do think real estate stocks investing moves in cycles. There are times where people become increasingly bearish and increasingly bullish. I think trying to time box or time bound those is a foolish error. I think
Yeah.
if you're in the market long enough, you can feel when the masses get greedy and you can
Yeah.
feel when the masses get scared.
That's right.
Trying to
Yeah.
put an artificial time on it is
Yeah.
foolish
And to
error.
that point, that's where I'm going to close this session with
Oh, okay.
some charts of my own to actually show you what the masses are doing.
Nice.
But just to hit on a couple of more that were kind of interesting in this. I mean, I couldn't validate these numbers up here, but he says when debt was 4 trillion, our payment was 250 billion. When the debt ballooned to 16 trillion, our payment was still 250 billion because the interest rates went so low. But
Wow, interest rates went down 75%. Okay.
right, well,
Maybe. I don't know.
yeah, again, I didn't validate the numbers. But he says when debt begins to outpace GDP, debt to GDP makes new highs. The Fed is forced to use the balance sheet to soak up excess debt.
Yeah.
Fed and governments around the world will be forced to continue cutting rates to accommodate, which I think is probably true. Another one that I had a little bit of it, and I think this was just an oversight on his part, but he showed this slide here and he pointed out that, you know, every time we get up here, this is
Yeah. What is that?
the
What are
10, I
those
think it's
lines?
the 10-year
Oh, so it's like the
10 day
10 and 2
10
or
day
something?
moving average of the put call ratio. This is
Oh,
the
put
put call.
caller. Got
Yeah.
it. Okay.
So he pointed to this. He says, "Look, this is what happened in 22. It got way up here, and then we bottomed. Well, this wasn't 22. This was 23. First of all, and
Oh,
the second thing that he kind of didn't really expand on, but I did because I took this chart, his chart, and recreated it, and I showed what actually happened in 23. Put call ratio got up here, and that was the low, but only about a month later, it went down. It was actually lower, and we actually hit a new low. So that wasn't the low. The low was about a month later.
okay.
So it wasn't completely accurate. And some of my charts I actually got into more specifics on. All right. Blah blah blah. Big picture. There's a huge amount of interest payments that need to be monetized. We all know
A-
that. I think
Amen.
by now.
That's the big problem.
Yeah, that's the problem. Currently, very similar to the 1950s. Debt to
Hmm.
GDP then was very high. Government moved to manage debts. And the baby boom generation is what solved it.
Hmm.
Now it's AI and robotics to improve
Efficiencies,
productivity, right?
productivity, right?
Um, China and US agree on tariffs. And by the way, as an aside, it's not on the slide, but he said he read this once China and U.S. agree on tariffs, and then he said, and they will.
Yeah. Okay.
U.S. will lower the value of the dollar, already happening, to allow them to stimulate and buy more U.S. bonds. I think that's probably going to happen.
So he
That way,
thinks
China.
so again, historically speaking, Trump has very much been a strong dollar president. So what he
Mhm.
is saying is Trump's going to be a weak dollar president?
He's saying Trump will have no choice.
Okay. So he's saying it'll be taken out of his hands. Okay, I can see that.
Mhm. Yeah. The China can stimulate without risking a collapse. One of the things that he talked about a little bit here, he explained the rest of the world, what it means for a lower dollar for the rest of the world, not
Okay.
just China. So some country in Africa that wants to refinance their debt, they
Hmm.
do it with US dollars because the reserve currency. And
Correct.
if the dollar stays high, it's a lot more expensive for them to do that. If
Hmm.
the dollar comes down, it's much cheaper for them to do that, which improves global liquidity.
So with improved global liquidity, again, back to his call on that chart, he thinks housing continues up for a couple of years.
Yeah.
Assets in general.
Yes, that's right. Assets in
Okay.
general. Yep, exactly. Rising liquidity should also push the ISM higher, should into the high 50s.
Hmm.
Let's see what else. US dollar falling. Global M2 is reported at 108 trillion. Again, I didn't validate these numbers, so
Yeah, I'd have to look that up. I had heard M2 was falling, but again, I don't know when these numbers are. But I
M2.
do think you have to follow the M2 money supply. I agree with that.
Yeah, I have an M2 chart. It's actually been rising lately.
Oh, okay, cool. Good to know.
Tariff wars were an unexpected shock. Liquidity rates are rising fast due to a falling dollar, low oil prices, and rates. So those are the three things that he
Hmm.
points to that helps or is are major components of global liquidity.
Okay. All
Falling
right.
oil, falling US dollar, and falling rates. That
Mhm.
all adds to global liquidity, which then adds to increased asset prices. Global liquidity moving yet even higher.
Yeah, that's the punchline of all this is he's calling for another asset bubble
Yeah,
reinflation or whatever you want to
right.
call it.
That's right. Yes. Yeah, that's right. Over the rest of this year into next
And
year, and
next,
then
right.
we hit the wall.
Well,
So
he also said just to not to interrupt, but we also could delay that 2 years. So in his
yeah,
world, he's given himself 3.5 years of asset inflation, up to three
yeah,
and a half years,
yeah. The year he puts on it is 27.
and then goes on to say it may be delayed 2 years.
No, 25, and it may be
Oh, to
delayed.
27. Okay, got it. So yeah, so 3 years roughly, up to
Right. So,
three
the, so
years.
the delay is till 27.
Got it.
Mine has been around 29 to 31, somewhere around there.
Right. Okay.
So we'll see. So here's a summary: 17-year stock cycle, 18.5-year real estate cycle, 26 or 27. Always hard to tell, of course.
Yeah.
Business cycle showing rising liquidity. Cycles versus business cycle versus liquidity. This is if history is to repeat. Liquidity always wins, which is true.
Yes, I agree with that.
All right. So
Okay.
now let me show you on my website on the charts page a couple of things. First, based on his presentation, I put together a liquidity chart
Oh, nice.
right here. So I use those components that he mentioned: dollar, oil, interest rates. So those three are at the top, and then commodities and manufacturing. And then this is the total index. This is the total US index down here, BTI,
Got it.
basically the stock market.
Hmm.
All right. So you can see the dollar is falling clearly
Hmm.
right there.
Hmm.
10-year yield started falling, then it went back up, and now it
Hmm.
kind of really can't make up its mind.
Right.
But if global liquidity is going to improve, then this should fall.
Go down. Should
Right.
being the operative
This
statement.
should
Yep.
go down. Oil is definitely going down
Yep.
already. Commodities are kind of going sideways,
Yep.
but recently they've been going down quite a bit. Manufacturing has not started going back up, though.
Not yet.
So this is one that we need to watch. Actually, all of these we need to watch and see if they continue. So this
Okay.
is 22 back here. The other thing he commented on is once the dollar starts falling and global liquidity starts picking up, it's about a 10 to 12 week lag time before it gets into the markets.
Oh, wow. Okay.
All right. So I went back to 22 when right here, the dollar was rising and liquidity was tightening, right? You can see actually
Mhm.
right here, oil and commodities, they started falling even before the dollar did,
Right.
right here. But in this 12-week period when the dollar was falling, that's when the market bottomed
Hmm.
in October of 22, and it's been in a bull market ever since then.
Okay.
All right, so this is the stock market down here. So there's the 12-week lag period right there.
Got it.
So this was the peak in the dollar right here. There's the 12-week lag period basically puts us next week.
Okay.
Next week is when that 12-week period ends.
Okay.
So if all of this premise is accurate, if it comes true, if it repeats, I should say, then we should start getting a rally.
Hmm. Okay.
The bottom should be in. So if the dollar continues to fall, if rates start coming down, the oil continues to fall, then the market should rally.
All right.
Assets in general,
Assets. Right.
right?
Okay.
So the other chart that when I went through on Friday, and anyone can go back to my YouTube channel and watch what I did, but I went through this
Mhm.
holy daily routine section. I did the weekly analysis and I went through each of these, the daily routine,
Nice.
and I basically said, are there green shoots? Is there anything telling us that there's some green shoots popping out of the ground? Maybe, the market's getting ready to grow now.
Right. Right.
And at the end, I would say the jury was out. In fact, most of them weren't really showing any green shoots.
Interesting. Okay.
They were,
So not
they were,
yet.
they were bottoming. They were definitely bottoming, but they weren't really reversing, except for one,
Hmm.
except for one, which I had not looked at for quite a long time. And it was actually surprising and really interesting.
All right.
And that is the new highs versus new lows
Oh, okay.
over 10 years. This one right
Huh.
down here. So that's what I want to show you.
Okay.
So this is the chart. So this is the
Oh,
S&P. Look at these down here. These are
yeah.
so this basically is the New York Stock Exchange new highs minus new lows.
Right. That's an extreme right there.
That is extreme. And there were four other extremes. We're going to
All
look
right.
at each of those to see if they can give us any clues. And this is the current one. It's down just like these others were. And look what
Sure.
happened. I drew some vertical lines to show you
Yeah.
where
I would argue three of the four were clear bottom, and then the other one was just, I don't know, 2 weeks early, 3 weeks early.
this one over here.
No, the middle one around April.
This
Yeah.
this was COVID. That was COVID.
Ah, well, that makes sense. Okay.
Yeah. So that went down very, very fast. All right. So this was 2016 over here.
Yeah, that looks like a bottom to me.
This is the last trade war
Sure, it
right
looks
here.
like a bottom. Yeah.
That's COVID. That's
Yeah.
22
Oh,
bear market,
yeah.
and this is
Interesting.
where we are right now. This is 3 weeks ago. All right. This is
Is
a weekly chart. This is
this?
a
I was
weekly.
just going to ask. It's a weekly chart. Okay.
Yeah. This is a weekly chart. So this little blue one is this past week, and then the bigger blue one when we had that big run up, that big
Yeah.
rally. That
Yeah.
was 2 weeks ago, and then 3 weeks ago was when we had the big dump,
Got it.
right? And
All
that big
right.
dump
So
put
that's a
this at
green shoot, at least.
so yeah. To me, that is really interesting. Every single time, pretty much every single time, it goes down below negative 500, way down here.
Right.
Every single time, it has not been the bottom, but it has been very close to the bottom.
Yeah. Yeah. It's another extreme, right? The VIX or the VIX over
Yeah,
60 or
that's
whatever.
right. So let's look at these a little closer. Let's get a closer view of each one of these. So
Okay.
I'm going to start with 2016 and go through today.
Okay.
So here's 2016. This again is a weekly. So the vertical lines are in exactly the same place as they were in that previous chart.
Got it.
There's the big dump. That I would call that capitulation,
Me too.
right?
Yep.
And then the very next week, the market is still a red bar, but it went up a little bit. But look at the new highs versus new lows. So what this implies, if you think about what this chart is telling you, what this implies is all of these new lows that happened during this week
Hmm.
all came back.
Yeah. They found their bottom. They found their,
Huge buying. That's what does that.
yeah.
Huge buying to send it back
Well,
up.
well, that and no more selling. You've already washed out all
And
the,
no more selling. Yeah, that's right. No more selling. All right. But the actual bottom didn't happen for 1, 2, 3, 4 weeks. And you didn't really know for 5 weeks when
okay.
it started to go back up.
So it
So
was close.
remember right now we're 3 weeks in. So we're pretty much right here on this blue bar right now.
Okay.
All right. Now, if
Yep.
we
I like it.
look at this on a daily chart, and the line will still be there. So there's the line. Now remember, that line was a weekly bottom.
Hmm.
So it's an aggregate of 5 of these bars,
Right.
right, to make it a weekly. But you can see the actual bottom happened roughly about 8 days later,
Yeah. So
nine
there
days
was
later.
one more big washout.
One more washout, then it rallied and it came back down and put in a double bottom.
Got it.
And that double bottom, you can see it didn't have nearly as many lows as this one did.
Hmm.
All right, so we still
Interesting.
could do this. We still could
Oh
come
yeah,
back to a
for
double
sure.
bottom, but this is the kind of thing to look for. All
All
right,
right.
let's look at the next one. Next one is the last trade war. So there's the
Hmm.
weekly way down
Yep.
here.
Big
In
washout.
this
Yep.
case, the next week it actually made a lower low, but by the end of the week, it had
Was up.
closed
Yeah.
higher than the previous week.
Yeah.
So that little tick mark to the right is the close. All right, and that was the bottom and started going up. If we look at that on a daily, oops, still weekly. There's the weekly
Mhm.
bottom
Yep.
right there. And you can see it's about a week later was the actual bottom.
Got it.
And then it went up from there. All right.
I
The
like it.
next one is COVID. So here's COVID. The actual bottom, this is the capitulation right there when it went so far down. Well, this is a weekly, remember, was right in the very first week of COVID.
Hmm.
So that was the third week of February, went all the way down. And then we continued for 4 more weeks. And the fifth week is when we started to come back.
Okay.
All right. Pretty much the same as the first one that I showed you.
Hmm.
In this particular case, there was a lot more selling.
Yeah.
So it didn't
Once
come
once
back.
in a lifetime event kind of does that.
Right. Right. But this was the biggest one right here where that
Mhm.
vertical line is. All right. So we'll go to the daily on this. So now you can see that on the daily,
Oh,
it's
interesting.
started way over here, but you have to take 5 bars because it's
Right.
actually an aggregate. So you're going to have to take all 5 of these bars together.
Huh.
But in this particular case, the bottom was over here. So about a month later. And again, about 4 or 5 weeks
Sure.
from that big capitulation bar, about 4 or 5 weeks until the bottom
Hmm.
actually happened. All right, now let's look at 22. Actually, meant to do this, take this off so it look like the other ones. So here's 22.
Hmm.
There's the capitulation week.
Yep.
Now we'll look 1, 2, 3, 4 weeks.
Yeah.
5 weeks
Okay.
is definitely starting back up again. All right,
Yep.
there's the big capitulation. If we look at it on a daily, now in this particular case, this was a year-long bear market.
Yeah. Lots of us selling different
So there
times.
was a lot of selling going on through the whole year, but this was the biggest one right here
Hmm.
this week. And in this particular case, again, about a month, about 4 or 5 weeks later, was the actual bottom.
Got it.
And it
Yeah.
started coming back. All right. The last one is right now, where we are today. All right. There's the weekly
Hmm.
red bar right there. We're 1, 2.
So if we go out 2 to 3 more weeks, what does that put us in? Middle of May?
It will put us in the beginning of May.
Beginning of May.
So
Okay.
1, 2, 3 will be the first week of May. It'll be
Okay.
just before the Fed meeting.
Oh,
It will
there we go.
probably be it'll probably be right around CPI, which CPI we didn't talk about this, but CPI is going to fall off a cliff in
You
May.
think? Oh yeah, the last base effect. Yeah, yeah, yeah,
Yep.
yeah.
It will, and there are other things that I've been reading about with consumers pulling back, and
Oh,
all of
that's
that.
nasty.
All of that's going to cause CPI to go down too. And I think the Fed. Some people are saying the Fed is behind. I think they might be behind because we may be headed for deflation.
Well, it's funny you bring that up. I brought that up on the daily financial news today. I think Jerome Powell is going to once again be proven wrong because he and his cronies are talking about the risk of inflation. And I'm like, dude,
That's
you're
right.
not paying attention. You
That's
might
right.
get a slight bump, but this is a deflationary event going on right now.
Right.
You're
Yeah, we
you
might
better
get a
wake your
slight
ass
bump.
up.
We might get a slight bump in June and July.
Right. Yeah,
But
yeah.
we could be at two. I mean, I thought we might be at 2.2 or 2.1 in the next one. We could actually be at two in the next one.
You think May will be two or could be two?
It could be potentially, but it's going to be
Wow.
it's going to be bigger than most people think. All right,
Yeah.
let's look at the daily on today's. So there's the daily right there.
Yeah.
So you can see it looks like we're already starting to come back up. Now we had two down days at
Right.
the end of last week. And based on the other ones we looked at, it's still possible it comes down and makes a double bottom before it goes
Double.
back up, or it comes
Yeah.
down a little bit, or it makes a
Right.
higher low before it goes back up.
Yeah, so really what you're pointing at, really to your, again, go watch your discussion from last week on your channel. But this is really the first green shoots that you're seeing because everything else you've looked at is like, nope, just bottoming, just bottoming, just bottoming.
Right.
This
Right.
is encouraging, maybe?
Yeah.
Okay.
Yeah. I think so. Well, I mean, we don't really know yet. It's only one. It's only one data
Sure.
point.
Of
And
course.
all of the other ones that I looked at on Friday in that video were not showing that things were coming back. They were showing that they were at the bottom,
Mm,
but not necessarily coming back. Other than the bottom finder that I created on my website, it's on the charts page for those that are subscribers. The bottom finder actually has some encouraging look to it. So you can
mm.
see right here, this is the NASDAQ 100. The percentage of stocks above the 20-day moving average was zero,
Yeah, I remember
zero
that.
right
Yeah.
there. So even with the slight downtrend last 2 days of last week right here, when it got
Hmm.
rejected at the 21 moving average,
You're
still
still
there were
holding up. Yeah,
there
still
were
holding
still
up.
more stocks. It's actually went up a little bit, and so did the
Did it?
50.
Mm.
So this might be a little encouraging sign here as well.
Okay.
And the VIX is pulling back, and put call ratio is pulling back. So I mean, all these could reverse quickly,
Sure.
but right now, I
Well,
mean, it
yeah.
looks to me like this was probably the bottom right here.
Okay. Well, that's why people need to tune into your channel, Breakpoint Trading, because you do this daily when the market's open and you're not traveling. So that's very helpful. And of course, we do our Sunday reviews each
Right.
week.
But I will be traveling.
Understood.
Um, the next 2 weeks, we probably won't be doing it.
Okay. All right. No big deal. All right, man. Well, do me one more favor, show your website, and we will wrap this up.
Breakpointtrading.net. Don't forget the net.
Yeah, .net.
.net. Lots of good stuff out there. The newsletter is right here.
YouTube channel at the top and the blue button.
Lots of good stuff in the newsletter. Oh, there's
Yep.
a cartoon that I think is brilliant. Actually,
Okay.
this
Let's
is
take a look.
interesting. This is in the newsletter. What if you invested at the top of the market every time?
Okay.
What if you jumped in at the 2020 peak, or at the 2000 peak, or the 2007 peak before the financial crisis, and the whole
Hmm.
market fell apart, and you say to
Right.
yourself, "What the hell am I doing? I don't know what I'm doing. This is ridiculous. I lose money every time I do this, but I'm not going to sell. I'm just going to leave it there,
Yeah.
and I'll wait till it bottoms, and then when it starts coming up, well, I don't really trust it. I want to make sure that it's coming up. So you wait until the next peak and you buy again, and it bottoms. What if you did that? Bought at the peak every time. Guess what? Your overall return will be 7.1%.
Yeah, this goes back. I forget who told me this, but apparently there was a study about the best investors, and the punchline is the best investor is a dead investor
Yeah.
because they don't trade.
Right.
That's a
That's
very
true.
interesting study.
Yeah.
All right,
So I mean,
folks.
if you got young kids or something, just buy an S&P ETF
Yeah,
and don't touch it. This is the one I thought was brilliant. If one expert says it's raining and the other says it's sunny, Your job as an investor is to ignore them both and instead look out the freaking window.
Boom. Go outside, folks. Take care, buddy. Have a great day.
All right. Have a good one. Happy Easter.
Easter. Happy Easter, everyone.